Hey, if you own a rental property, you need to listen up. You might be sitting on an incredibly powerful tax tool and not even know it. We're talking about taking the paper losses from your property, from stuff like depreciation, and using them to get real, actual savings on the tax bill from your main job. So how on earth is that possible? Let's dive in.
So let's just ask the big question right up front. Can that rental property you're managing on nights and weekends actually lower the taxes you owe from your 9-to-5 W-2 job? I mean, it's a pretty amazing idea, right? Using one investment to slash the tax bill on your primary career.
And the short answer is yes, it absolutely can be done. But you knew there was a but coming, didn't you? With the IRS, there's always a catch. It's not quite that simple. There's one major fundamental rule you have to get past first.
And that big hurdle, it has a name. It's called the passive loss problem. Once you really understand this rule, you can start to figure out how to work around it.
Okay, think of it like this. The IRS sees your financial life in two totally separate buckets. In one bucket, you've got your active income. That's your salary, the money you work for. In the other bucket, you've got all your passive stuff, like the income and losses from your rental properties. The default rule is super simple. Those two buckets are walled off from each other. They do not mix. So losses in your passive bucket can only cancel out gains in that same passive bucket. They can't leak over and help you with your W-2 income.
So if those buckets are walled off, the next question is pretty obvious, right? How do we break down the wall? Or maybe build a bridge? That's exactly what we're going to get into. How to unlock those rental losses and put them to work. This is where it gets fun. What if you could build a pipe connecting those two buckets? Well, it turns out the IRS actually leaves a few blueprints lying around, special exceptions that act like that pipe, letting your passive losses flow right on over to offset your active income. You just have to know which blueprint you're allowed to use. So, the tax code basically gives us 4 distinct paths to make this happen. Let's walk through each one so you can figure out which, if any, might be the right fit for your situation.
All right, let's start with path number 1. For a lot of you out there with a regular day job, this is going to be the most accessible one by far. It's called the $25,000 special allowance, and it's pretty straightforward. If your adjusted gross income is under $100,000 and you actively participate, which just means you're involved in the big decisions like choosing tenants or okaying repairs, then boom, you get to deduct up to $25,000 of your rental losses directly against your other income. It's a fantastic exception built for the everyday landlord.
Okay, on to path number 2. And I'm going to warn you, this one is a whole different animal. The bar to clear here is much, much higher. This is the big one, qualifying as a real estate professional. And the IRS is not messing around with this. Real estate can't just be your side hustle, it has to be your main job. You have to spend more time on it than any other single activity, and get this, you have to be able to prove that no one else, not your property manager, not anyone, spends more time on your properties than you do. The source material puts it bluntly, for most people, it's not going to happen. It requires an insane amount of proof.
Now, path number 3 is less about the hours you grind and more about having a really clever business structure.
This strategy is called a self-rental, and it is a brilliant setup if you're a business owner. Here's how it works. First, you set up a trust. Second, that trust owns a commercial property. And third, your active business rents that very same property from your trust. With a special tax election you have to file in the first year, you effectively build that pipe between your buckets. This lets the passive losses from the property, like depreciation, flow right through and cancel out your active business income. It's a game changer, but it is complex. You absolutely need a tax professional to set this up right.
And that brings us to our 4th path. This is one that has just exploded in recent years, thanks to platforms like Airbnb. This is often called the short-term rental loophole. Now, let's put it right next to the real estate pro status to see what's different. The main rule here isn't that real estate is your primary job. The rule is that the average guest stay in your rental is 7 days or less. But, and this is a big but, it's not passive. You still have to materially participate, which usually means 500 or more hours a year. And just like the pro status, you have to be the one putting in more time than anyone else. So while it's a fantastic option for an active host, it still demands a huge and provable time commitment.
There's one more little bonus option worth mentioning, the Augusta rule. It's a bit different.
It allows your business to rent your own home from you for up to 14 days a year, tax-free. So think about your business paying you a fair price to use your house for a 2-day annual retreat instead of renting a hotel ballroom. It's a neat little perk, for sure, but it's limited. It's not a path for writing off massive depreciation losses like the others.
Okay, that was a lot, I know. We covered maybe 4.5 paths. Let's just take a quick step back and put it all in perspective with a reality check. Here's how it all shakes out, ranked by difficulty. The easiest path, hands down, is that $25,000 deduction, perfect for W-2 earners under that income cap. Then, you've got the self-rental. It's moderately difficult to set up, but it's a great fit for business owners. Then you get to the hard stuff, the short-term rental and the real estate pro status. These are demanding and really best for very active or even full-time investors. Seeing it laid out like this should give you a pretty clear idea of where you might fit in.
But for any of these more advanced strategies, this is the absolute non-negotiable rule. It all comes down to your records, your documentation. Whether you're trying to prove you worked 500 hours on your Airbnb or that you're a full-blown real estate pro, you must have good numbers and good tracking. You have to be able to prove it. End of story.
And finally, let's zoom out from all the tactics and the tax code. Let's talk about the single most important piece of advice in this whole explainer. You can call it the investor's golden rule.
And here it is, the tax benefits are the bonus. They are not the main prize. A good investment has to make financial sense all on its own first. It's always better to make a profit and pay some tax than it is to chase a deduction right into a bad deal. So please, don't let the tax tail wag the investment dog.
So now you've got the map. You know the main routes you can take to potentially turn those rental property losses into a powerful tax-saving tool. The only question left is, which one of these paths, if any, makes sense for you to go investigate further with your tax professional?